Question 29. I'm going to use two videos to complete this question. On January 1st, the partners of Van, Bacon, and Cox, who share profit and losses in the ratio of 5:3:2, respectively, decide to liquidate their partnership. The trial balance at this date follows. So in this trial balance, we know the three partners' current capital balance, and we also know something that related how we need to adjust their balances, because, for example, Van have a loan of 50,000, which means that Van owes the company 50,000, and Bacon also have a loan of 40,000, but that's credit, which means that the company owe him 40,000. Alright, the partners plan a program of piecemeal conversion of partnership assets to minimize liquidation expense. All available cash less amount returned to provide for future expense. It is to be distributed to the partners at the end of each month. A summary of the liquidation transaction follows. So the question asking us to prepare a schedule to compute the safe installment payment made to partners at the end of each of the 3 months. To solve this question, let's first prepare the pre-distribution plan. Okay, so here's the plan. In this pre-distribution plan, first we start with their current beginning balance. So beginning balance for Van, Bacon, and Cox are follows. Van's balance is 78,000. It equals to its current book value of the balance 128 minus the 50,000 Van owes to the company. For Bacon, it equals to its current book value balance 100,000 plus 40,000 the company owes to him, and then Cox has 84,000. So like what we did before for other pre-distribution plan, we need to eliminate their capital balance one by one, assume certain losses. So the first step is to eliminate, done by calculate who is going to be the most vulnerable partner. Okay, so to eliminate Van's capital balance, let's assume we need a loss amount of x1. So x1 times 5 over 10. So that's because based on the ratio we are provided here, the 5:3:2, and then the Van will take like 50% of loss. And to eliminate its 78,000 total capital balance, the total amount of loss of x1 we need is 156,000. So we do the same calculation for other 2 partners, and turns out that Van is the most vulnerable one, or the weakest one, and we can eliminate his capital balance with the smallest loss. So if we assume a loss of 156,000, and then Van will take 78,000 of that, and its step 1 balance 0. And Bacon's step 1 balance is 93,200, and Cox is 52,800. Okay, so after the first step, Van's capital balance is eliminated, and then we need to eliminate one of the remaining 2 partners. So for Bacon's, now it's going to take 3 over fraction is going to take 60% of total loss, and we need the 60% of total loss equal to its current remaining balance, and we get x1 equal to this 155,333. And to eliminate Cox remaining balance, we need 132,000, which means that Cox is more, it's a weaker one compared to Bacon. So then we need to eliminate Cox in the next step. So here, assume a loss of 132,000, then Cox will take 52,800, and then its remaining balance will be 0 in step 2. And then Bacon will still have 14,000 left. Okay, so next let's move on to this this summary of the liquidation transactions, and to show what's going to be the amount of distribution we can use every month. And based on the information that is provided in this part, and we can complete, like prepare a T account for cash, like a T account for cash. So we have debit on the left hand side and credit on the right hand side. That is credit on the right hand side. So the beginning balance of their cash is 28,000 is given in the question, and this is the January beginning balance. And in January, they collect 51,000 accounts receivable. They sold their inventory for 48,000. And okay, so that's all the debit. And for the credit, they paid 4,000 for the liquidation expense and paid 88,000 to some of their creditors. And also at the end of January, they want to retain or keep 20,000 cash on hand. That will be their required ending inventory. So after we complete all those debit and credit, and then the amount they have available for distribution is the plugin number. Okay, so this plugin number equals to 15,000, which means that at the end of January, they will distribute 15,000 to their partners. Okay, then let's move on to February. So the January beginning balance will become January's ending balance will become February's beginning balance. And then in February, they paid another liquidation expense of 5,000, and they require to retain 8,000 at the end of February. So then we have another plugin number related about how much they can distribute to their partners. That is 7,000. Okay, so there's no other transaction in February. Then let's move on to March. And March beginning balance is February's ending balance, that's 8,000. In March, they sold some of their equipment for 156,000 cash, and they paid another $7,000 for liquidation expense. And then they decide at the end of March, they are going to maintain no cash at all, zero amount of cash, and they are going to distribute everything they have, all the money they have for the partners. And that's another plugin number, and the total amount they have available for distribution is 157,000. Okay, I'm going to use next video to show how those distributions can be allocated among the three partners. Now I'm going to use the last schedule to show you how we can distribute cash to the partners, and but to get those numbers, we rely on the two schedules we just prepared. In January, based on the schedule LT account here, we know that in total they have 15,000 that is available for distribution. So for the 15,000, we are going to allocate 14,000 to Baco, and the reason we need to allocate 14,000 is based on the predetermined pre-distribution plan. So which means that Baco is going to get the first 14,000 that's available when it's available. Okay, so after Baco get 14,000, and in January there are 1,000 left. So 1,000 equals to a total of 15,000. 14,000 is given to Baco, then 1,000 left. So for the remaining 1,000, we can give 60% to Baco and 40% to Cox, based on the 5:3:2 ratio that we know. The 5:3:2 ratio that is given. Okay, and then now we finished the January distribution. In February, they have 7,000 cash that's available for distribution. So we are going to allocate the 7,000 based similar to that prior 1,000. So 60% goes to Baco and 40% goes to Cox. Alright, so then let's move on to March. In March, in total, they have 157,000. That's a big amount, which means that it's likely they are going to have some available for van. And the first step is to say how much we need to use for Bagel and Cox. So the total amount we need to allocate to Bagel and Cox is going to be determined by the total amount they need to cover the remaining. So in total, they need another 130,000, but because they already allocated 1,000 to 1,000 in January and 7,000 in February, so in total, they still need additional 124,000 to complete the step 2 allocation. So in the step 2 allocation, still Bagel gets 60% and Cox gets 40%. Okay, so after we complete this step 2 allocation, so that comes in something related to here. Then there will be something available for van. So the total available for van is the total amount that's available in March minus the total amount we just used. So the amount we just used is 124,000 minus 124,000. So there is a 33,000 that can be allocated among the 3 partners. And van is going to get 50%, Bagel get 30%, and Cox get 20%. Okay, so based on then we can, so then all the cash, that's available cash, has been distributed, and then the ending balance of the totals that allocated to each partners is 16,500 to van, 103,100 to Bagels, and 59,400 goes to Cox.